Everyone. Hi, AJ, Ellen, Anatoly, Andrea, Bernard, Bildad, Bob, Chi Chong, David, Emmanuel. I'm only at E. This attendance list is still moving. Hi everyone. Okay. Hi everyone. I'm not gonna say like hi to every single of you. Hey Jack. Hey Robin. I started the webinar slightly earlier, so let's just give everyone a bit of time to join. By the time everyone joins, it should be 5:30 Singapore time, and then we can start the webinar. Hi, Muhammad. No video. Let me see. Bob is saying no video. Can I check if everyone can see my screen? It should say IC Markets webinar, trend trading, 2 out of 2. Hey. Oh, me. Oh, I did turn on the video. I can see myself. Can you guys not see me? Let me turn off the camera and turn it back on. Now, can you see me? Now, can you guys see me? Okay, cool. Thanks, Robin. Thanks, David. Thanks, Bob. Thanks, BL. Thanks, Muhammad. Okay, it's 5:30, but I still see this attendance list moving quite a bit. So maybe we give everyone else like 1 more minute, 2 more minutes to get in, settle down, and then we can start today's webinar. Hi, AK, welcome. Hi. Attendance list still moving. Okay, you know what? I'm just gonna slowly do the introduction. By the time I'm done with the introduction, I guess everyone would have been in already and settled in. Hi, Samuel. For those who are in Singapore, I just want to say this weather is the weather the last few days is like terrible. I don't know about you guys. So humid, it's so hot, I can barely breathe. I don't know if it's because I'm heavily pregnant or it's because of the weather, but it's just so bad. Okay, anyways, welcome again, everyone, to today's webinar brought to you by IC Markets. We're going to talk about trend trading today. Okay, part 2 out of 2 parts. I didn't take you guys last week, right? So I'm going to do part 2 for you guys. We're going to be identifying the end of the trend. Okay, this is something even until today, I find it's hard to master. Okay, I know there are tools to like identify the end of trend. We're going to go through it today, but I myself, that's why every time we do these webinars, I always tell you guys I am a trend trader. I need to identify trend. I need to know whether price is going up or down. If price is going up, I go in for a buy. If price is going down, I go in for a sell. But identifying the end of trend is totally different from my style of trading, because identifying trend means that if price was going up, you are basically identifying where it's going to end, and then you are going to get in on a sell at the end. So you're aiming to get in at the peak. You know what I mean? The peak, like at the very reversal point. So I think that is a skill in itself. If you guys can master that, that will be great, because you will be able to make a lot of profits in trading, right? You'll be able to catch a lot of long moves. Okay, just a reminder, guys, I am heavily pregnant. So if it seems like I am gasping for air or whatever, it's because I am heavily pregnant, and I do find it a bit hard to breathe. Okay, because I was in a meeting before this and they were like, "Are you okay? Are you okay? Are you sick?" I'm not sick. I just a little short of breath, but I'm okay. Okay, so don't worry about that. Other than that, let's start today's webinar. Thanks, Sebastian. Oh yeah, that being said, I only have 1 more month left with you guys. Okay, disclaimer, you guys know how this works already. Just a reminder, Is there a recording on part 1 edition of Trend Trading? Yes, there's a recording on all our webinars. It will be posted on YouTube, but I did find out from you guys, I think Desiree was the one who was saying that eventually they do post it on YouTube, but it takes them a while to post it. So maybe in a week, right? Correct me if I'm wrong, guys. It's in a week, right? They do post it up within a week or maybe a few days, if I'm not mistaken. Okay. Anyways, I don't watch the webinars because I don't want to watch myself talking. Have you watched a video of yourself and cringed before? That's me. Okay, so disclaimer. Anything I share in this webinar should not be construed as trading advice. This is not a signals group. This is not a forecasting group. Please do not take this as trading advice, investment advice, or any form of financial advice. Okay, this is purely educational. Even if we were to call a trade, don't take it as a signal. Just take it as our way of showing you how we got the trade to begin with. Okay, so the whole point is educational. Nothing about this is a signals group. Other than that, please be reminded that trading is very risky. Trading Forex and CFDs carry significant risks, especially if you are using leverage. Okay, the more leverage you use, the more risky it becomes. This affects everyone. I don't care if you've been trading for a decade. I don't care if you've been trading for 1 month, 2 months, or 20 years. Okay, risk applies to everyone. Okay, if you guys read the book that I was sharing with you guys, so I was saying how I read this book called Reminiscence of a Stock Operator. It's one of my favorite trading books. You know that even the #1 trader in the world can go bankrupt from trading. Okay, so risk applies to everyone. Please do not have God complex when you are trading. God complex meaning that you think you are never wrong. Okay? Okay, cool. Everyone cool with the disclaimer? I'm going to start with today's webinar. Our agenda for today, trend trading, part 2 of 2 parts, identifying, just give me a sec, guys. There is a plastic on my floor that keeps blowing. I can hear it moving around. Just give me a sec. Okay, I'm back. So sorry about that. Okay, our agenda for today, identifying the end of trend. We're going to go through some of the indicators that you will be using, not you will be using, but the ones that you can use to identify trend. Obviously, there's going to be way more things that can help you identify trend, but these are the some of it that we're going to talk about today. So the first one will be MACD, okay, CCI, Parabolic SAR and ROC, Williams percentage, Ren, and okay, I don't know if I'm pronouncing this right. I think it's called Cheddar momentum oscillator. Okay, so we're gonna look at these indicators and I'm gonna give you a rough idea on how to use it. Obviously, I can't really go in depth because in this 1 hour we're gonna talk about 1, 2, 3, 4, 5, 6, 7 indicators. So I cannot spend too much time explaining on every one of it. So I'll just give you a rough overview on the indicators. Okay, so let's start by introducing your host. I think majority of you already know me because a lot of you are still calling me Bob. Okay. Other than that, for those who are new here, never met me before, my name is Cassandra. You can call me Cass. I am an external analyst and a prop trader at Average Fortune Group. For those who don't know what Average Fortune Group is, we are a we are an investment research firm. Okay, so we are the finalists for the best Forex and equity research for 2019, 2020, and 2021. Okay, 2022 is not out yet. That's why you don't see the numbers here. Okay, but okay, I don't run this firm. Okay, this is Des profile. Again, I think I keep reusing his profile by accident. Okay, but anyways, what we do at Everest is that we do a lot of research and back testing. So research and back testing, we research on these indicators that we're teaching you today. We do a lot of back testing on it. On top of that, we kind of forecast where we think the markets are going, and then we advise banks, brokers, hedge funds, financial institutions, and you guys here on this webinar, where we think the markets are going. Okay, so other than that, I myself, in my own personal trading, I am a full-time prop trader. For those who don't know what prop trading is, it basically, well, how I became prop trader is I took a test, a couple of tests, I passed the test, and then I got funded. Whatever I make from trading, I get a profit split from the companies that I trade for. Okay. These tests are not that easy to pass. Only less than 2% of people ever pass this test. A few thousand people take the test on a monthly basis. Hey, Bildad, I'm good, thanks. How are you? Okay, so only out of a few thousand people, only less than 2% ever pass this test. So how I did that, and I did this a total of 6 times actually. Okay, how I did that is by using technical analysis. So I am a technical analysis specialist. Therefore, if you guys have any questions, please ask me in the chat box. I will be able to assist you when it comes to technical analysis. Okay, I spend a lot of time researching and reading and studying technical analysis. Okay, but don't ask me about fundamental analysis. Okay, please don't ask me about like economic data, FOMC, jobless, the unemployment rate and things like that. Okay, I do not specialize in that, and if you ask me, I probably wouldn't give you very accurate answers anyways. Okay, so ask me about technical analysis because I only have like 1 more month with you guys. We can ask you about baby and parenting next time. Yes, you can. Okay, so ask me about that because I only have 1 more month with you guys, because like I mentioned, I'm heavily pregnant. I will be gone in a month. Gone as in going on maternity. Okay, so take a chance to like get it. I kind of got some difference between normal and hidden divergences. Okay, so the hidden divergence is just that it's not as obvious as the difference between hidden divergence and not regular divergence is just that it's not as obvious, but the concept is still the same. If the chart is showing higher high or higher low, and then the oscillator is showing a different thing, it's the same thing. It's just that sometimes you can't really tell. If we have time, we can go on the charts. I don't think we'll have time because today we're going to talk about 7 indicators. Okay, so basically hidden divergence is just very hard to spot, but basically it's the same concept as a regular divergence. Okay, hi best friend, hey Tuan. Okay, so the reason why I put a divergence cheat sheet here is because today's 7 indicators, a lot of it, actually I think majority of it are all oscillators. Okay, and how you find trend reversal is by looking for divergences. So you need to first understand divergences before you can know how to use today's indicators. Okay, so divergences means that, let me grab my pen. Okay, anything that is blue means that it's on the charts. Anything that is red means that it is the oscillator or the indicator, or it's not on the charts. Okay, the charts meaning that, you know how you go on trading view, like this is the candlesticks, it's moving, it's moving, it's moving, it's doing whatever it's doing. Okay, this is the charts. Okay, this is the graphical charts, and then this price, $5, $10, whatever the price is in the charts. The oscillators are usually at the bottom. Okay, they are the indicators. So it can be a MACD, stochastics, RSI, Parabolic SAR, or other things. Okay, it's usually at the bottom if it's an oscillator. If it's not an oscillator, let's say you're using things like moving average, Ichimoku cloud, Bollinger Band, it will be drawn onto the charts. But when you're using oscillator, it is usually at the bottom of the chart because you are using it to compare to the charts. Okay, so if you guys don't already have this cheat sheet, I suggest you download it. Okay, I did not make this. Okay, I just pluck it off from Google. Okay, because the cheat sheet is the same for everyone. Okay, Yen is asking, when you have the chance later, please let us know how much period of duration of divergence must form over, or is it based on number of peaks, trend lines, drawing, and identifying. Okay, minimally for divergences, I want 2 touches. So I'm comparing higher highs and higher lows, right? So I want to see one higher high, and then I want to see what it's saying on the oscillators, and that should be able to satisfy my divergence. Obviously, the more touches, the better, but minimally, I want at least 2 touches. Okay, I hope that answers your question, kinda. If not, later I will show you when I get the chance. Okay, please download this, okay? If you go on Google, you can get an even more dynamic cheat sheet, but most of the cheat sheet looks like this. Okay, this is very important. Even for me, until today, I use divergence every day. Every day, I try to look for divergence. Every time I'm trading, every webinar that I do, I look for regular hidden divergence. But the thing is, I myself, what time frame do you use? I use the 1 hour, the 4 hours, or the daily. Yeah, I thought you draw the lines differently, whether it's an uptrend or a downtrend. That's correct. Okay, so so if it's an uptrend, you draw it at the top. Okay, if the charts is showing an uptrend, okay, we're talking about the charts now. Okay, the charts, not the indicator. Okay, so the indicator is at the bottom. The oscillator is at the bottom. The charts, I'm talking about the charts. So on the charts, if price is moving on an uptrend, you want to compare the higher high. If price is moving on a downtrend, you want to compare the lower low. Okay, so it's in this example here, in this cheat sheet here. That's why I think this cheat sheet is so crucial, because like sometimes even me, I've been trading for so many years, and I've been trying to spot divergences for so many years. Sometimes I myself forget, wait, should I be drawing it at the top or should I be drawing it at the bottom? So you just need to remember, when it's in an uptrend, draw it at the top. When it's on a downtrend, like here, you draw it at the bottom. Okay. Or actually, you can also compare both. You can also draw like higher lows or higher highs. Okay, so usually I draw it at the top, but if I don't see anything at the top, you can draw the one at the bottom as well. That means you can try to spot for higher lows as well and lower lows. Okay, this is an exaggerated divergence where price is going straight. Okay, price is doing a double top, for example, okay, or doing a double bottom. And then on the oscillator, it's showing a downtrend or an uptrend. Okay, so this is important. Please save this if you haven't already. I actually printed this out and stuck it onto my wall so that I can refer to it. Okay, because there's so many different kinds of technical analysis out there, it's very hard to remember everything. If you can remember anything, you're like a dictionary or Wikipedia. You're like an encyclopedia for technical analysis. I can't remember everything, so I don't leave it to my brain, I leave it to my notes. Okay, I don't trust my brain, I forget stuff all the time. So that's why I print all this cheat sheet and I stick it around and I reference it when I need to. Okay, so that's that. Remember the divergence, okay, that's important. Can we download this cheat sheets as file? I'm pretty sure you can. So what I did is I just Googled like divergence cheat sheet on Google, okay, and I went to images, and the one that makes the most sense to me, the one that is the most comprehensive, I just downloaded it, I saved it, and I printed it, and I stuck it onto my wall. When I forget, I just refer to it. Okay, so please use that. Okay, so let's start with today's indicator. The first indicator to get is called a MACD. Can you guys let me, yeah, find them as a search. That's right. Thanks for asking, Richard. Okay, can you guys let me know in the chat box if you guys have used MACD before? I personally use MACD, not all the time, but I do use MACD. I think it gives quite accurate information, but the rest of you, let me know if you've ever used MACD before. No, you not used it. Okay, in the meantime, I need to drink water. I'm really out of breath. Okay, half of you have never used it, half of you used it. Have any of you ever used RSI or stochastics? At least. I just realized there's like 4 Bobs in this webinar. 5 if you include me. Oh, by the way, for those who don't know why I'm named Bob, it's because our company has 2 Cassandras. And to make everyone's life easier, I just told everyone I was just like, what's the most generic, easiest name I can think of? Okay, Bob, just call me Bob. It's easier for everyone. Because they used to call, when they say Cassandra, both of us will turn and like, yes. So I'm just like, okay, you know what? Just refer to me as Bob from now on. Okay, I've used RSI. Okay, so the good thing about if those of you have used RSI and stochastics before, it's the same thing as MACD. Okay, you use RSI and MACD, and RSI, stochastics, and MACD the same way you use the other oscillators. Okay, so I'm gonna explain a bit about the history today, because today we're not going on TradingView, right? Today is basically learning about the indicators. I always tell you guys, right, in this webinar that you can learn the history about, like, for example, Fibonacci, for example. You can go and learn the entire history, read the entire textbook, and go and read the life story of Mr. Fibonacci himself, but it's not going to help you make money in trading. The thing that helps you make money in trading is knowing how to apply the indicator, okay? But because today our main purpose is to understand the indicator, I will still be talking a little bit about the history, okay? All this is not so important, it's just good to know, okay? It's not going to help you. Knowing where these indicators come from is not going to help you make money, but it's just good to know, okay? So the moving average convergence divergence, also known as MACD, is an indicator developed by Gerald Appel in the late 1970s. Appel was the technical analyst and author of the book Technical Analysis, The Power Tools for Active Investors. Okay, so that's one book you guys can go read if you want to. So Appel developed the MACD as a tool to help traders and investors identify changes in momentum and trend in security prices. He believed that the MACD could help traders and investors identify potential buy and sell signals by measuring the differences between 2 moving averages and of different periods. Okay, so basically how this indicator was formed was to measure the EMA1 and the EMA2, and then with that histogram will form at the bottom. Okay, so initially the MACD was calculated using the difference between 2 simple moving average of different periods. However, Appel later modified the calculations to use exponential moving average, which are weighted more heavily towards recent price action. So the MACD indicator quickly became popular among the traders and investors and is now widely used technical analysis tool. Its ability to identify changes in momentum and trend make it valuable tool for identifying potential buying and selling opportunities in security prices. So it is important technical analysis indicator used by traders and investors to analyze the momentum and trend of a security price. So MACD consists of 2 lines, the MACD line and the signal line, and the MACD is calculated by subtracting the 26-period exponential moving average from the 12-period exponential moving average. Okay, so the settings will be 26, 12, and the signal line is a period of 9 EMA of the MACD. So when I'm using MACD, the settings that I use on TradingView is the default settings. If you guys notice, when I use stochastics, I always change it to 21, 5, and 3 because we find that 21, 5, and 3 is smoother. It gives you smoother lines and it gives you more accurate results. But for EMA, we find that the default settings of 26, 12, and 9, which is the default one, you don't need to change anything on TradingView, gives you accurate enough information. Okay, so the MACD line crosses above the signal line. It is considered a bullish signal, indicating that trend may be shifting to the upside. Conversely, when the MACD line crosses below the signal line, it is considered a bearish signal, indicating that the trend may be shifting to the downside. Traders and investors are to use the distance between the MACD line as a signal line to gauge the strength of momentum in the security price. The larger the distance between the two lines, the stronger the momentum. Overall, MACD is a versatile and widely used technical analysis indicator that can help traders and investors identify potential buying and selling. Okay, so now let's look at how we're going to apply MACD if we were to use it on TradingView. Okay. Step number one, you're going to plot your MACD. So it's going to appear at the bottom of the chart. Okay. It is typically plotted as two lines. Okay, the MACD line, the difference between the two exponential moving average and the signal line, 9-period exponential moving average. This is good to know. It's not really that important. More importantly, you need to know how to use it to look for trend reversal, because today's topic is about trend reversal, right? So we're gonna, how you use it is the same way you would use your RSI and your stochastics. Basically, look for crossover. MACD crossovers can be used to identify potential trend reversal. When a MACD line crosses above a signal line, it suggests that the security may be entering an uptrend, and conversely, the MACD line crosses below the signal line. Okay, it can indicate that price is going to the downtrend. So you then want to look for divergences. So MACD can also be used to identify divergences between indicators and price action of the security. For example, if the price action is making higher highs, from the MACD is making lower highs, this could be a sign of bearish divergences. Okay, so I'm going to pull out my pen. We can see that price is making lower lows here, but on the MACD it's making higher lows. Okay, this is a sign of bearish divergence. Okay, this is, oh sorry, this is a sign of bullish divergence because the chart is showing down, but MACD, the oscillator, is showing up. So when it's different, when there is a difference, you follow the indicator, you follow the oscillator. This is the oscillator's way, or the indicator's way of telling you, hey trader, this downtrend is ending and I now want to go in an uptrend. Okay, so how you use it, how I used to use it. Okay, I don't use MACD very often anymore, but how I used to use it, and I did find that it's very accurate, is that, okay, first you need to identify the bullish divergence, which we already did. Okay, price is going down here, but on the MACD it's going up. Okay, the question is, where do you get in? You now have an indication, someone is whispering in your ear, hey, there's a chance of a trend reversal. Okay, MACD is whispering in your ear, there's a chance of a trend reversal. Okay, knowing that price is going up or knowing that price is going down is not going to make you money. Knowing where to get in is going to make you money. Remember, I told you guys, every webinar, almost every webinar I always say the difference between an amateur trader and a very, very good trader is the very, very good trader's ability to know where to get into the market. So just because I know price is going up or I know price is going down, it doesn't mean I'm going to make money. Like, let's, I'll give you an example. In 2016, I think, there was a hype over Bitcoin, and then my friend and I was like, oh my god, I think this thing is going to be like super big one day. That time Bitcoin was at $5,000. Today Bitcoin is at, I don't know what's Bitcoin price today, I think it's 40,000 if I'm not mistaken. Okay, so that time Bitcoin price was $5,000, and then we're like, oh my god, we should go and buy, blah blah blah. So we know it's going up, but if you don't take action and you don't know where to get in, you're still not going to make money. So same, MACD is showing you that it's going to go up. Where do you get in for the buy? Okay, number one, you can get in at this area here. So you then need to combine other things such as support and resistance. You're going to combine support and resistance. You're going to wait for price to pull back. If it doesn't reject and it does a breakout, this is where you get in for a buy. On top of that, that will be the exact same area that the blue line crosses the red line. Oh, sorry, yellow line. Sorry. Okay, so when the blue line crosses the yellow line, it is an indication that price is going up. When the blue line crosses the yellow line to the downside, it is an indication that price is going down. So this is your first signal of the buy. This is second signal of the buy. I would want to put my entry here, my stop loss here. and my take profit either here or here. Okay. So this is exactly how you would use MACD. But again, please don't use MACD on its own. Please always combine your indicators with other things. Indicators are meant to be used as a confirmation. It is not meant to be used on its own. If you use an indicator on its own, I can promise you out of 10 trades, you are going to lose at least 4 of it. Okay, so to increase your chances of winning more trades, you should use the indicator. On top of that, you should combine it with support resistance. You should combine it with fibs. You should combine it with trend lines, channel, and then you should combine it with other indicators. Okay, if you are going to use it on its own, I can assure you your winning rate is not going to be amazing. Okay, you want to win more in trading, lose less. Okay, cool. So everyone clear on how to use the MACD? It is the same way you use it on the RSI and the stochastics. If everyone's clear, I'm going to move on to the next indicator, which is the CCI. Remember, if you ever get confused when it comes to oscillators, just go back to this cheat sheet. This cheat sheet will give you the answers to everything oscillator. Okay, not everything in trading, but everything oscillator. This cheat sheet will give you the answer to it. Okay, please download this cheat sheet. Seriously, download it, print it out, paste it in your notebook, whatever it is. Use it as your wallpaper, whatever it is. This cheat sheet is going to help you either save a lot of money or make a lot of money in trading. The parameters, please. Do you mean like the settings? Do you mean the settings? The settings, we use the default settings. Okay, cool. I'm gonna move on to CCI, which is our next indicator. Okay, so the CCI, also known as the Commodity Channel Index, was developed by Donald Lambert in 1980. Lambert was a commodities trader and a technical analyst who wanted to develop a tool that could help traders and investors identify potential buying and selling opportunity in the commodity market. Okay, so Lambert does not mean this can only be used in commodity. When you do the divergence line on the MACD, do you need the histogram that's called the red line to also cross with the red to green, meaning to use divergence? Can you draw on the same mountain? It must cross the zero. I cannot draw divergence. It's just the same mountain growing bigger. I hope this makes sense. Okay, I know what you're trying to ask. Yes, you can also use this. Okay, very good question. Very good question, Desiree. The settings, Muhammad, we just use the default settings. So if you go on TradingView, you pull out MACD, whatever settings they are using, just stick it to it. You don't need to change anything. Okay, very good question, Desiree. I actually forgot to mention that other than these two lines, you can also use the histogram. You can also use these mountains to identify divergence. So you can see in this case, even this, you know what, I don't really, I think it's called a histogram, like the term of this mountain looking thingies. Okay, you can see that the red are getting shorter and shorter, making this like kind of like this uptrend. Okay, and then you can see the green is getting shorter and shorter here as well. So kind of indicating that there is a loss of momentum. Actually, what this thing does, right? This histogram, I'm very sure it's called histogram, if I'm not mistaken. Correct me if I'm wrong, okay, in the chat box for those who know the exact term or name for this. When you see it getting smaller and smaller, it just means that the momentum is losing. So in this case, you see that the red is getting shorter and shorter. It means that the bearish momentum is decreasing, and there is a possibility the bullish momentum will start to rise. Okay? Yes, it's called a histogram. Thank you, Neil. Okay, so yes, you can also use the histogram as a reference to draw your divergence. I hope I answered your question, Desiree. But yes, there's two ways to look for divergences. You know what? When I was using the MACD, I was actually only using the histogram. I actually didn't even look at these lines. But because today I chose to use this picture as an example, I totally missed out that you can use the histogram as well. So yes, use the histogram. You can use the histogram as well. Must the histogram turn to green and red again, then you can draw the divergence. Okay, actually, like if the histogram turns to green and then red again, it doesn't matter. The most importantly is you get is this line that you draw. So it doesn't have to turn to green. It can all be red, as long as you are able to draw like this uptrend that is sufficient enough. So it doesn't have to turn to green. But most of the time when it comes to MACD, it will turn to green. I actually don't think I've ever seen the charts where it's just red all the way. Usually it will red, green, red, usually. Okay, cool. Okay, I'm going to move on. Okay, so I've got a question here asking, does that mean you can only use this on commodities? It is initially intended to be used on commodities, but no, you can also use it on other stuff. But obviously, if it was initially meant to be used for commodities and even has a name commodity channel index, you should try to use it on commodities, but actually it can be used on all pairs. Okay, a lot of indicators can be used on all pairs. Okay, so Lambert believed that the traditional technical indicators such as the moving average were not sufficient enough or effective in volatile markets such as commodities. He also believed that the price fluctuations in commodities tended to be cyclical, and that the tool that used to identify these cycles would be useful for traders and investors. So to develop the CCI, Lambert calculated the difference between the typical price of a security, the average of a high and low and close price, and its simple moving average. He then divided the difference by a measure of its standard deviation to create an index that ranged from -100 to +100. So a reading above 100 indicates that the security is overbought, okay, while the reading below -100 indicates that the security is oversold. So traders and investors can use these readings to identify potential buying and selling opportunities. The CCI quickly gained popularity among traders and investors, especially in the commodity markets. Its ability to identify cyclical trend and potential buying and selling opportunities make it a valuable tool for technical analysis. Okay, so how do you use it? Again, if it's above 100, it's overbought. If it's below 100, it's oversold. Okay, so the CCI it is a momentum indicator that can be used to identify potential trend reversals as well. How do you use it to identify potential trend reversals? Okay, number one, you're obviously going to plot it onto your chart. It's going to appear at the bottom of your chart. Okay. It is typically plotted as a line that oscillates above and below a zero line. Okay, so you're going to look for, number one, you're going to look for the overbought and oversold area. Remember, overbought is above 100 and oversold is below 100. So you can see at this area here. Oh, where's my mouse? Okay, you can see at this here, this numbers here. Okay, all these oscillators, right? No matter what oscillators they are about the same. Okay, they just come in different numbers, come in different colors, come in different names. But I think when it comes to like usability, like how you use oscillator, it's the same. Okay, so it just depends on which oscillator you like to use. I like to use RSI and stochastics because it's just one, it's very simple, it's one line. Okay, I like to simplify my trading. There's no point of you overcomplicating things. So the other way is to look for divergences, same. So CCI can be used to identify divergences between the indicator and the price action of the security. For example, if the price of the security is making higher highs, but the CCI is making lower highs, it could be a sign that the bearish trend reversal may be imminent. Identifying potential trend reversal When the CCI crosses above or below the zero line, it can be a sign of potential trend reversal. If CCI crosses above the zero line, it suggests that security may be entering an uptrend. If it crosses below the zero line, it can be a sign that the CCI is starting a downtrend. Okay, so let me grab my pen. So we went through 3 ways on how to use it. Number 1, if it is reaching 100, it means that it is overbought and oversold. So how I would use the CCI is the same way how I would use the stochastics and RSI. You use a horizontal line. You can identify support and resistance. Whenever price reaches this area, I would expect a trend reversal. Okay, but in this case, it didn't work. This example. Okay, same. I would expect trend reversal. I would expect some kind of reversal there. Okay, that's one way you can use it. This example doesn't look like it's working very well, but theoretically, that's one way you can use the CCI. Number 2, if price crosses above this zero line, it is bullish. You can see it worked very, very well in this case. It worked very, very well because it crossed 100, and you can see from here it starts to go up, and that is your first sign of trend reversal or any kind of trend indication. Okay, if it goes below 0, you can see here. Let me see. Here, price starts to drop as well. Okay, so it's the same. It's working quite well for this example. Okay, the third way you can use it is, again, the same way you use MACD, which is to identify divergence. Okay, in the event you see this example, I didn't include a divergence. Okay, there is a divergence, sorry. There's one right there. Oops, sorry. Okay, price is making higher highs, for example. Okay, it's making higher highs. Okay, this is just a very tiny example of an divergence, but you see on the charts, it's making lower highs. Okay, so this is another example of divergence, and then this is your sign of getting in for a sell. Okay, so again, like I say, when it comes to oscillator, please tell Imran, get trading view. Hey Abdullah, I can't go on TradingView today because we need to cover this indicator. So today's main aim is to cover these indicators. Need to go through these slides today, and then if I have time, which I definitely will not have time for today's webinar, we can go to TradingView, but definitely I won't be able to go on TradingView today. Okay, but yeah, this is how you use this indicator. Again, guys, I'm going through 7 indicators to get today. Okay, so it's going to be very hard for me to go in depth on all of it. I'm just going to give you a brief overview on most of it, and then if you guys want to go in depth after this webinar, you guys can research more into it. But for today's webinar, I'm just going to briefly talk about all 7 of it. Okay, so the next one, not really an oscillator. This is charted onto the chart. This is called the Parabolic SAR. Okay, the stop and the reverse was developed by Parabolic SAR. The SAR literally stands for stop and reverse. Okay, so it was developed by J. Wells Wilder Jr., and renowned technical analysis and author of several books on technical analysis, including The New Concepts in Technical Trading System. This was published in 1978. Okay, so Wilder developed, so that means this indicator has been around for like 40 plus years. I think that is an achievement. Okay, because why? Not many indicators have been around that long and it's still useful. So there are a lot of indicators has only been around for like 5 years, 10 years. They're relatively new. The oldest indicator that is still very popularly used today is actually my favorite indicator, Elliott wave. Elliott wave is one of the only indicators, I think if not the only indicator that has lasted for 100 years. Okay, that shows you how good this indicator is. Okay, thanks for asking, Bob. The settings for Parabolic SAR will be default as well. Actually, most of the settings today will be default. All the settings today will be default. Okay, so Wilder developed the Parabolic SAR as a tool to help traders identify potential trend reversals in security prices. This is one of the most simple indicators to use. The parabolic SAR is based on the idea that security price will continue to rise or fall in the parabolic curve until it reaches a point of exhaustion. So the parabolic SAR uses a series of dots that are plotted above and below security prices to indicate potential trend changes. When the dots are below the price, it is considered a bullish signal. Okay, when the dots are above the price, it is considered a bearish signal. Okay, so parabolic SAR calculates the base of the current high and low security price, as well as the acceleration factor, which is increased each time a new high and low is reached. This helps to capture the increasing momentum of a trend as it progresses. This indicator has become a popular tool among traders and investors and is used in a variety of markets, including, so it can be used in stocks, futures, forex, commodities. Its ability to identify potential trend changes makes it a valuable tool for technical analysis. So how do you use it? Obviously, you're going to have to pull it out on TradingView or whatever platform is you're using. If you're using MT4, MT5, whatever it is, the charts that you are using, you pull out your parabolic SAR and you'll see all these dots, like all these stars, all these dots. This, okay, there's a very long explanation here, but I'm just going to give you my very quick explanation on how to use it, because I only have 15 more minutes to talk about 1, 2, 3, 4, 1, 2, 3 indicators. Okay, I have 15 minutes to talk about 3 more indicators, which is 5 minutes each indicator. Okay, so when price reaches, like, it'll come out on the charts like this. Okay, when it reaches, you see the dot starts forming at the bottom of the charts. That is the indication to get in for a buy. Okay, you know what I mean? Okay, so let's say price is moving up, it's moving up, moving up. Suddenly you see the first star appear here, or like this stars appear here. This is parabolic SAR's way of informing you, hey, a trend reversal might start. Okay, so parabolic SAR is, I would say, is one of the easiest indicators to use. Hi, Jamilu, welcome. Okay, it's one of the easiest indicators to use. Okay, so price is going down, it's going down, it's going down. You see this appearing. This is parabolic SAR's indication to you to go in for a buy. Okay, so this is exactly how you would use this indicator. Simple enough. Do you guys have any questions? Do you need me to repeat that again? Literally, this is how you use the indicator. Price is going up, going up, going up. Suddenly the parabolic SAR is showing you this. Okay, the next downtrend, the stars start to appear above your candles. This is the indicator's way of showing you that, hey, a downtrend is going to start soon. You might want to consider getting in for a sell, or you might want to consider getting out of your current trade, which is you might want to consider taking profit right now. Obviously, this doesn't work 100% of the time, but when it does work, it works very well. Okay, everyone's good, right? Everyone can understand parabolic SAR. Okay, good. Thank you. Thank you, Mama. Thank you, Joash. Yes, you can move on now. Is it on close or any touch? Again, okay, so let's say price is moving up, right? It's moving up, it's moving up. You suddenly, this parabolic SAR suddenly appears here. So that's the indicator's way of showing you that trend might reverse. Then again, this is where you combine support resistance. Okay, so you combine support resistance. So it's not whether it's the closing of the candle or not. Okay, it's not about the closing of the candle or not. It's whether when this appears, then you combine it. It is now your chance as a trader to go and combine it with other things. Okay, then you go and combine it with your swing, your support resistance. Then now you wait for a breakout. At a breakout here, you enter for an entry. Then you play it down, you play it down, play it down, play it down, play it down until you see the next candle forming at the bottom. By right, this is supposed to be a take profit. But of course, if you're only using the parabolic SAR, this is how it works. But because our style of trading is we combine other technical analysis, right? So for us here, we would have already taken profit because here there's a swing low. Hi, Abdullah. I don't know. Thanks for asking. Okay, so we're cool with this. I'm going to move on to the other indicators. We've got 10 more minutes. I am going to have to brush through the rest. Okay, the next is called the ROC. The ROC stands for rate of change. It's an indicator that was developed by renowned technical analyst J. Wells Wilder again. Mr. Wilder really, really likes developing oscillators. Okay, so it was developed in the mid-1970s. Wilder was an author of several books, technical analysis, including the new concept of technical trading systems. You guys can look into that, which introduces several new technical indicators, including ROC. So ROC is a momentum oscillator that measures the percentage change in price between the current price and the price and period ago. So Wilder believed that measuring the rate of change in a securities price could help traders and investors identify potential buying and selling opportunities. The ROC calculations is based on a simple formula that compares the current price of a security to its price and periods ago. The results is then expressed as the percentage. A positive ROC reading indicates that the security price is increasing, while a negative ROC reading indicates that the securities price is decreasing. So traders and investors use ROC indicator to identify potential trend changes and to confirm that the strength of the current trend. When ROC is above the zero line, it is considered a bullish signal, indicating that the trend may be shifting to the upside. Conversely, if the ROC is below the zero line, okay, like in the example I showed here, it is considered a bearish signal, indicating that the trend may be shifting to the downside. So ROC is a widely used technical analysis tool that can be applied in a variety of markets, including stocks, futures, forex, and commodities, okay, and cryptocurrency. You can use it as well. I've tried it before and it works. Its ability to measure the rate of change in a security price makes it a very valuable tool in identifying potential buying and selling opportunities. So this is what it's going to look like when you pull it out. Obviously, how we're going to use it is going to plot the ROC on the charts. It's going to come out at the bottom. Okay, it's not like the parabolic SAR. So parabolic SAR comes out on the chart itself, but these are oscillators that comes out at the bottom. Okay, so same thing. You can look for crossovers on the zero line. That's the first way. Is the zero line. Crossover is the first indication of trend reversal. Okay, so you can see price going up above here. Here, there's an uptrend. Okay, when price goes below, then you can start a downtrend. Okay, so it's a bit delayed. It's a bit of a lagging indicator. Okay, because you see price crosses here in the uptrend. The uptrend actually started a long time ago. The uptrend actually started here. Right? It actually started here. So, okay, this indicator is a bit lagging, but it will give you some information that may be useful to you. Okay, so other than that, how I like to use this indicator is the same way I use RSI and stochastics, is to look for divergences. Okay, divergences is, okay, you know what, guys? This was plotted wrongly. Okay, we go back to our cheat sheet. Our cheat sheet will show you that if you are plotting at the top, you are going to plot at the top of your oscillator as well. If you are plotting at the bottom, you will plot at the bottom of your oscillator as well. Same, okay, or even for hidden divergences, if you're plotting at the top, you're looking for higher lows or higher highs, you are going to look for higher lows and higher highs on the oscillator. So it's never inverse. It's always, if you're drawing the trend line at the bottom on your oscillator, you're drawing the trend line at the bottom as well. Okay, so in this example that I put, so sorry, it used the wrong example, but doesn't matter. I do still see the oscillator. So if you are plotting, you would plot this way. Okay, so price is going up, okay, but on the oscillator price is going down, okay. So that is your first sign of bearish divergence. Okay, so remember the correct way to plot is the same area. If you're plotting at the top, you plot it at the top. Oh, we're not going through gun indicator today, AJ, so sorry. Okay, our last indicator, and then we're done for today's webinar, would be the William percentage R. Okay, so the William percentage R is an indicator that measures the level of securities closing price relative to the highest high and the lowest low over a specific time period. It is a momentum oscillator that oscillates between 0 to negative 100, and the values above negative 20 is considered overbought, and the values below negative 80 is considered oversold. Okay, let me pull up what the indicator looks like. Oh, sorry guys, I actually have two more indicators. Okay, you know what? I won't be able to explain the history. Okay, so I'm not going to explain the history. I'm just going to tell you straight how to use this indicator. Okay, how do you use it? Obviously, you plot it on the chart. It's going to appear at the bottom of the chart because it is also an oscillator. Okay, this is an oscillator. So you're going to look for overbought and oversold levels. That's number one. William percentage R reading above 20%. Where's my pen? Above 20%, which is this line here, okay, indicates that is overbought. That means once it goes above this, you want to identify your support resistance area. When it reaches your support and resistance, by right, it's supposed to reverse. Okay, by right, if it reverses here, it's supposed to reverse on the chart, which is kind of a little bit. When it reaches here, supposed to reverse but didn't. Okay, but technically this is one way you're going to use it. This is one way you can use it. Okay, so if it's above 20, it means that it's overbought. Rating below negative 80, which is right here, means that it's oversold. Okay, means it's time to get in for a buy. Okay, so other than that, you're going to use it to look for bearish and bullish divergences. Similar to other momentum oscillators, the William percentage R can also be used to identify divergences. Let me erase everything and let's try to spot the divergence in this example. Okay, so an example of a divergence would be, I don't see a divergence in this example, but we went through the whole thing just now. We know that if price is going down here and the oscillator is showing up, for example, it means that price is, oh, actually this is a divergence. Okay, this is not the clearest divergence, okay, because it's higher high, then lower high. Okay, there's a high here and then there's a lower high. So you see this like this, you see price going down, but on the Williams percentage R, price is going up. This is your indication of a bullish divergence, and somewhere along this line you can get in for a buy, and true enough, price continues to go up. Okay, so every indicator that we went through today kind of works in the same way. Okay, it kind of works in the same way. Can you please tell us whether there is a good Elliott wave indicator on TradingView? If there is a good Elliott wave, I think I use Elliott wave as a whole. Elliott wave should be used as one indicator, right? Elliott wave is a very good indicator. You can find it on TradingView. It's at the left side corner. Okay, but Elliott wave is not something that you can learn overnight. I personally took like 6 months to master it. Okay, but if you can master it, you will be able to get quite a bit of profit. Okay, I'm going to move on to our last indicator, which is the CMO, which is a chat momentum in oscillator, another oscillator again. Okay, this is what it looks like. Not going to be able to go into the history, but basically the CMO was developed by Tuksar Chat, a technical analysis, the author of several books and technical analysis. So he developed this in 1990. So this indicator has been around for like 30+ years to improve the existing momentum indicators such as the RSI. Okay, so he didn't think the RSI was good enough, so he came up with this oscillator. Okay, the CMO measures the difference between the sum and the gains of losses over a certain number of periods. The CMO is designed to provide more responsive and accurate signals than other momentum indicator by taking into account the asymmetry of price changes. Okay, I'm going to go in on how you can use this indicator, and then we'll be out of time already. So the CMO, obviously, you're going to plot it. It's going to appear in the bottom of the chart. It's going to be an oscillator. Okay, the CMO, you look for extreme readings. So trend reversal can be signaled by extreme readings on the CMO. When the CMO reaches an extreme reading, it indicates that the security is overbought and oversold. So what is the extreme reading? It is plotted a line that oscillates between positive 100 and negative 100. So extreme reading would be somewhere, for example, this would be an extreme reading because this is the extreme lowest that is going. When you spot this, okay, it's the same way as we use any other indicator. When you spot this, you plot your support and resistance line. When it reaches this line, okay, I want to get in for a buy here. I want to get in for a buy here. Okay, so true enough, it reaches that line on the chart, it enters for a buy, comes back second time on the chart, you enter for a buy. If it were to come back a third time, somewhere on the chart, I will enter for a buy too. Okay, so these are the point of using the extreme readings. You can use this the same as RSI and stochastics as well. Okay, the second way you use it is to identify divergence the same way. Any way to identify trend reversal is to look for divergences between the CMO and the price of the security. CMO is a trending lower. It could be a sign that the trend is losing momentum and it could be due for reversal. Okay, so inversely, if it's trending higher, it means that it is also losing momentum, and then you can look for reversal. Okay, so same thing, we're gonna go look for divergence. That's why I say the cheat sheet at the start of the webinar is so crucial. Okay, so let's say you see a buy, you see price moving upwards here, but on the charts you see it going downwards. This is your indication of a bearish divergence, and you want to get in on a sell. And then on the charts, you're gonna like plot your support resistance, you're gonna plot your Fibonacci. If you see a breakout, that is your confirmation to go in for a sell. Okay, so that's all I have for you guys today. So sorry we had to rush through today's webinar. There was a lot to cover today. Other than that, I hope you guys learned something. Data overload, poor brain. We did a Q&A throughout the entire webinar. I hope you guys learned something new. Other than that, thank you from IC Market. I hope you guys learned something new. We touched on 7 indicators today. We can tell no matter how many people try to create a new indicator, everyone is trying to create a new indicator. I don't know if you guys know that. There are like hundreds and hundreds of indicators. But one thing you know about these indicators is that they have a lot of similarities. Okay, so which of the 100 indicators do you use in trading? You use the one that has been giving you the most results. So in my case, the one that has given me the most results is RSI, stochastics, Ichimoku, DMI. Okay, these are like really good indicators. So you guys decide which indicators have been giving you good results, and you guys continue to use that indicator. Okay, so thanks guys. I will catch you guys tomorrow. No, I'm not going to catch you guys tomorrow. I'm going to catch like Tuan and all the Bahasa people tomorrow. That Troy, I'm going to catch you tomorrow if you are joining for Bahasa webinar. But for the rest of you, I'll catch you guys next week. Remember, I only have like 1 more month with you guys. So if you guys have questions, please prepare your question and you can ask me in this webinar. Okay? Bye everyone. Name of oscillators. The whole webinar, we went through all the oscillators. Do you need me to go back to the... These are all the oscillators that we went through today. I'm going to leave this here so that you can take a picture. We went through MACD, we went through CCI, we went through ROC, Williams percentage R, we went through the check momentum, the CMO. These are all oscillators that we went through today. Yeah, I'm going to stay on this page for like 1 minute so you can take a photo, or you can write it down, and then you can go and Google if you want to, or like research more. No worries, everyone. Thanks. Take care. Okay, everyone good? If everyone's good, I am going to end the webinar. But your fave RSI is not here. I know. I don't choose the subject. I don't choose the topics, guys. I'm just here to present. I don't know who chose all these indicators. Right? Maybe it was IC markets or someone, but if I were to choose a topic I wanted to teach, it's definitely going to be trading psychology. This accelerates in the platform. Yeah, it is. Okay, bye everyone. Thanks. I'll catch you guys again soon. Bye.